Hey guys, welcome back to my channel. Today's topic is going to be a little sad, but we can learn a lot from it. So today we're going to talk about the reason why the SVB filed for bankruptcy. The collapse of Silicon Valley Bank, or SVB, a 40-year-old California headquartered bank that had become a startup tech sector favorite, has shaken the financial world in the past few days. And that's why in this video we're going to dig deep and find out the reasons behind the bank's downfall. So first, let's see where this bank came from. Silicon Valley Bank was founded in 1983 by Wells Fargo executive Bill Bierstaff and Stanford University professor Robert Medeiros to focus on the needs of startup companies. The two former Bank of America managers and tennis buddies came up with the idea over a game of poker in California. So they hired Roger Will Smith, who had previously headed a high-tech lending unit at Wells Fargo, to be the bank's first CEO and president. The bank finally launched on October 17 of 1983. When Silicon Valley Bank was founded, the banking industry did not have a good understanding of startup companies, particularly those that lacked revenue. The bank structured its loans with the understanding that startups do not earn revenue immediately, managing risk based on their business model. The bank connected consumers to its extensive venture capital, law, and accounting firm network. Its main strategy was collecting deposits from businesses financed through venture capital. It then expanded into banking and financing venture capitalists, adding services to allow the bank to keep clients as they matured from their startup phase. The bank's customers were primarily businesses and people in the technology, life science, healthcare, private equity, venture capital, and premium wine industries. I know it may sound a little hard to understand the banking system behind it, but from now on, I'll try to explain everything in a more simple way. So now, let's see how such a great bank, actually the 16th biggest bank in the USA, collapsed. The primary reason behind this was the economic downturn caused by the COVID-19 pandemic. So everything started from COVID-19. But how? During the pandemic, as more and more homebound people spend money on tech gadgets and similar items, tech companies used SVB to hold their cash, much of it used for payrolls and business expenses. So, with its sudden influx of deposits, SVB invested the money as all banks do. Only a few of banks' assets are normally kept as cash. If you want to understand banking, take a look at my video about banking system. So let's go on. SVB decided to invest billions in long-dated US government bonds, including mortgage-backed securities. These investments didn't look bad back then. Actually, they were pretty good investments then, as the bank was likely to hold on to the bonds for some time and see them through the maturity. But several recent factors combined to turn these financial decisions into the beginning of SVB's bankruptcy. And our story starts here. Everything was going great until last year Federal Reserve decided to raise the interest rates to control the inflation, which they couldn't. But as rates rose, the price of SVB's bonds, the mortgage-backed securities, fell, and the bank's bond portfolio lost significant value. Let me explain it this way. Let's say you have debts and you're short of money, and you have to pay your debts by the end of the month. The fastest way for you to pay your debts is to sell your assets, but the market is not good and you have to sell your, for example, house cheaper than you bought it. This is exactly what happened to banks' bonds. And at the same time, the tech sector found itself suddenly struggling last year after 2 years of growth. The most publicly discussed aspect of this crisis in the tech world was the mass layoffs announced by companies like Amazon, Meta, and Microsoft. Tech companies were also increasingly moving to draw on their bank deposits, and for SVB, this meant the beginning of the crisis that quickly brought the bank to its knees. So, As more and more SVB's customers asked for some or all of their deposits back, the California bank, short on cash, was forced to sell its bonds for liquidity. SVB was forced to get $1.75 billion loss after the sale, and on March 8, it announced to investors that it needed to fill this gap by raising capital. This made the people scared that SVB will not be able to pay its long-term debts and financial obligations, so the more and more people and businesses were trying to take their money out of this bank. And that's exactly how one of the greatest banks of USA went bankrupt. But what would happen after such a thing? Usually, one of the three scenarios could happen. The first is that there could be another bank to have the finances to buy the SVB, and by doing that they would have to pay its debts, like exactly what happened to Nokia and how Microsoft bought the company and paid its debt. The other thing that could happen is that Federal Reserve could print some money and give that to the bank to pay its debt, but by doing that they would make all those efforts put for raising the interest rates go straight to trash. So I personally don't think that that would happen. And the third thing that is more reasonable is that the Federal Reserve sold the assets of the company, and with the money it raises from that, it could pay its debts. So, in conclusion, if you have a bank, go look at your investment portfolio and change it before it's too late. And thanks for watching me. If you have any problem understanding or any questions, please comment them down below, and don't forget to subscribe and like my videos. Until my next video, bye.